And yeah, so there's your formula in formula form. And finally, we have volatility. And the volatility of a return is measured by its standard deviation, SD, R of A, and this can be estimated from the historical data. And a lot of the upper year students here will be quite familiar, but also, and for the, I guess, second year, and if there, I don't think we have any first years, you'll be seeing this very, very soon in your classes. So what determines asset prices? Intuitively, an asset with higher risk should have higher returns, as we mentioned in the last slides. If not, why would we want to invest in an asset if there's a less volatile alternative with the same return? So for instance, Bitcoin is an incredibly volatile asset that has seen some large returns in recent years, right? And stocks of companies that provide essential services such as the food industry would usually have low returns because they're quite stable and essential. So is all risk the same? No, it turns out investors can avoid some risks through diversification, and such risk is referred to as idiosyncratic. So for example, let's say Oscar Sunscreen Co. is quite a risky business. However, its returns are negatively correlated with that of Thomas's rain boots. That is, if Oscar's Sunscreen Co. sees a return of 10% in its stock price, Thomas's Rain Boots Industries Incorporated will have a return of -10 and vice versa. And an investor can invest in my company to freely avoid all the risk by also investing in Thomas's company as well. So investors can get rid of the risk by investing in both businesses, and this is the process of diversifying. And thus, there shouldn't be a risk premium present in the returns of either stock. So diversified risk is not rewarded by the market, as it can be freely avoided. That is, in this example, a portfolio that was half in my company and half in Thomas's company would have no risk, and so the risk premium would be 0. So given the same return as the risk-free rate. So is all risk diversifiable? So this leads to the natural question: is everything diversifiable? So this doesn't turn out to be the case. So the risk of a stock can be decomposed into 2 components: that of the market and idiosyncratic risk. And the overall market risk can't be avoided, because where else can we invest in? And so this is the only portion of the stock's volatility that should be rewarded. So this leads to the natural question: how much of a stock A's risk is associated with the market? And using some statistics, the answer is the volatility of the returns multiplied by the correlation of the returns and with that of the return of the market. So both of these terms can be estimated with historical data. And when this is normalized by the volatility of the overall market, this is referred to as the stock's beta. Just let you kind of take in the formula for a second. And so we get to asset pricing. So finally, the CAPM states that under some assumptions, supply and demand imply the following: the risk premium of an asset is equal to the beta of the asset multiplied by the market risk premium. And rearranging implies that the expected return of the asset is equal to the risk-free rate plus the beta of the asset multiplied by the market premium of the risk premium of the market. And as everything on the right-hand side can be estimated using historical data, we can then have an estimated for the stock's return. So this is your common CAPM formula of expected market return equals risk-free rate plus the beta minus the market risk premium. I think this was also one of your interview questions when you got into this club. So what are the applications of this? This estimate means we have a useful and a very simple way of telling whether a stock is over or undervalued. And in an all equity finance firm, this estimate of the discount rate can be used to discount future cash flows appropriately. In the firms with leverage, it can be used in combination with the cost of debt to discount future cash flows. And in either case, it's a tool to find the profitability of a project. And for people who took financial economics, I'm pretty sure most of your professors also said that the CAPM model is not the perfect model. It's not a very precise model, but currently it's the only model that can calculate the expected returns to this date. So that's the one we just have to use and kind of trust in it and make our own interpretations in the future. So some discussions, so CAPM assumes too much of the rationality and information held by the investors. And such assumptions contradict behavioral studies on investor decision-making. And furthermore, its predictions don't usually line up exactly with the historical data. Though, however, it's a very useful way of understanding how assets are priced and the effects of interest rates, changes on stock prices, and the market as a whole. Yeah, so investors are rational. Yeah, not usually. Otherwise, we would just have a very mellowed market. So we get into our regressions. This is going to be actually this is just kind of a sneak peek into your sector team activities this week. I gave your sector directors a copy of our data workshop 3, which we just did. And it's going to be using simple linear regression to calculate a stock's beta. And I'm just giving you a slight introduction here. So according to basic financial theory, investors design portfolios to optimize their expected returns, given a level of risk they are willing to accept through one's own risk appetite. And intuitively, riskier assets are only held by investors if they can expect a reasonably high average return for holding that asset. However, this is usually not the full story. Stocks, or really any assets, have their prices fluctuating every second. The amount of price fluctuations varies depending on the volatility of the stock. However, volatility is a combination of the systematic risk, or the risk that affects all of the assets, and idiosyncratic risk, the risk that only affects a specific asset or a group of specific assets. That's what we just talked about earlier. And without getting into detail, although there's not too much in this theorem, and we encourage all the members to always review and be comfortable with their basic theories in finance, idiosyncratic risk approaches zero as the portfolio becomes diversified, as we mentioned earlier. And as such, investors are only compensated for the amount of systematic risk that they're exposed to, the risk that affects all of the assets, as opposed to the volatility of each individual component in the portfolio. And a key measurement of a stock's exposure to systematic risk is the stock's beta. which is defined as the slope coefficient that is obtained by regressing a stock's excess return on the return of the entire market. So the beta of the stock can be interpreted as how well a stock's return matches the overall performance of the market. And to be technical, it is the average increase in expected return of the stock per unit increase in the return in the overall market. So yeah, I'll just kind of let you guys hear that again. So the beta of the stock is how well the stock return matches with the overall performance of the market. So, and note in the real world, like betas are calculated by regressing excess returns of the market against that of the stock. However, in order to calculate that excess return, we also need a risk-free rate for each day we have the data for. Yes, so we're kind of getting into the technicals of IB, of corporate finance, and now more of the banking is done quantitatively and less through the fundamental ways of just, looking at trends, stock tickers, and more about just taking large amounts of historical data, back testing them, and kind of predicting future expected returns. Of course, it's not perfect, but it does do a lot better job than the human eye can distinguish in a large data set. So yeah, so multiple linear regressions. So the beta of the stock is simply the slope coefficient of the market proxy in a simple linear regression. And a market proxy can be anything. It can be, and most commonly here, we'll use the S&P 500 since it's just the biggest, and that's what most proxies are based off of. And its most common application is in the CAPM formula, so the capital asset pricing model, where the historical beta of the stock is used to calculate the expected excess return given the market conditions. And however, there's many applications of this in finance. And of course, data analytics in general, where there may be multiple regressors that are of interest. And today we'll discuss the example of multiple factor models, and specifically the Fama and French factor models. So Fama and French argued that there were other factors aside from how the stock performed relative to the market, and that should be considered when predicting excess returns. And specifically, the two suggested that different types of firms have different size returns. For example, firms with small market caps typically have higher excess returns than big market, like big with quotation. I'm doing finger quotes, like you can see me. We should turn on video for our sector teams. Actually, I think that gives a more interpersonal session for all of you, if you're comfortable, of course. So have quotation marks big market cap firms, and the value of the stock typically outweighs growth stocks. So other categories have also been suggested by others, including Mark Carhart, who in 1997 showed that stocks which had the highest average return over the previous year outperformed stocks with the lowest average returns over the same time period in the current year. And as such, another factor that is often added in regressions measures the difference between returns between these groups as a way to measure the influence momentum of the stock's return. So today, in your sector teams, you'll recreate a simplified version of the Fama French 3-factor model, which includes the excess returns on the entire market over a risk-free rate. And a small minus big factor that captures the extent of which the small stocks outperform large market cap stocks, and a high minus low factor that captures the extent to which the value stocks outperform the growth stocks. So the value stocks are those with high book to price ratios, and the growth stocks are those with low book to price ratios. And again, in Jupyter Hub, so that's where we're going to be playing around with it today. Our recreation won't be exactly precise, as we'll be using simple logarithm returns and not excess returns over the risk-free rate. So yeah, so I believe all of your directors have the necessary material. For Shen's team, I think he didn't excuse it with me. I'm not sure if, but otherwise, just let me know. I'm sure he gave you some details at least. So why is MLR used in factor models? So in calculating a stock's beta, it might seem intuitive why regression is a suitable method. The beta is approximately how well the stock does compared to the market. And the slope coefficient of that simple linear regression captures how well the market proxy can predict the stock's return. As we mentioned earlier, the market proxy can be the S&P 500, can be any index or just any indicator that that kind of encapsulates the market as a whole. So the link between these two is obvious. However, why is the multiple linear regression used in multi-factor models? So the first answer is that while it's easy to measure the first factor, that is the return of the market or its proxy, it's very hard to quantify whether a stock has a small market cap or a large market cap, and also to the extent which it is a value stock or a growth stock. So so it's kind of a gray area. What's the threshold, right? So is it like let's say like small market is 5 million, I'm just putting up a number, is large market 5,000,001? Is it how much standard deviation does it have to be a large market cap? Or even for the growth versus value stock, for the high versus low book to price ratios, where is that cutoff? And furthermore, the factors in the Fama and French model use differences in returns between the small and the big, which is the value and the growth stocks, as opposed to simply the market cap or the book to value ratio of the stock. And as such, when running a multiple linear regression where the response variable is the return of the stock in interest, the regressors are these three portfolios, which you will see in the workshop, where it's the high price. Let me go back. The high minus low versus the small minus big. So those will be kind of your portfolio indicators. So these three portfolios, and thus there's no need to measure kind of the riskiness, the market cap, or the growthness. And instead, the regression produces coefficients that measure the extent to which the stock does better or worse when each factor portfolio does better. And if the coefficient of a certain portfolio is positive, it means that the stock does better when small stocks have higher returns relative to big stocks. And this would suggest that the stock is hence on the smaller side, while the coefficient of the market proxy, what we know as beta or market beta, the slope coefficients for the other portfolios will be known as factor betas. And noticing in calculating these factor betas, there is no need to ever use the market cap of the stock. The regression results will always tell us what we want to know. So here in the workshop, I believe we will be working with Twitter and Microsoft, and this is your predicted versus actual values, and this year moving average. And don't worry if you didn't understand like 80% of what I just said in these 3 slides on regression, because in the workshop, this is just kind of a sneak peek of it. It'll explain it wholly, and it will even give you kind of the code so you can play it with yourself. So let me show you. So yeah, this is what you'll be working with. And you guys should get the CSV files as well today. You might need to change up some of the directories, like where you're downloading it and where you're finding it. But yeah, so you guys will play with that today. You can change, I believe you can change the data set. I'll try to find the source of it. But yeah. So let's get into options. Let me just check so options are a type of financial derivative, and derivatives are assets whose value are determined based on the value of the different underlying asset. So simpler examples of derivatives include futures and forwards. So futures and forwards are promises from one party to buy a good for a predetermined price at some point in the future. For examples, airlines might use futures to secure the price of fuel ahead of time, so the cost of production in the future won't come as a surprise. And for futures, the value of the contract for the seller and buyer is easy to determine. If the current price is below the current contract price, the contract is generally favored towards the seller. And if the current price is above the price listed in the future contract, the buyer is better off. Just as a technicality, we need to take into account the time value of money and the interest rate when determining the present value of the future price. However, for the sake of basic foundational intuition, what I just said will suffice. So just ignore that last contract thing. And essentially, options, futures, derivatives, they're essentially just a form of contract between you and the seller. And so you guys are setting your predetermined time, price, date, whatever, and it's just gonna automatically go through at that point of time. So if you don't want to take on, let's say, too much risk, you can determine like, oh, for this asset at this price, I want out. You know what? I don't want to like wait for the drop, you know, like, or it'd be too late on it. So at this price, once it strikes it, I'm gone. And as I said, options are another form of financial derivative whose underlying asset is a stock. And because options are bought because they're cheap, basically. Sorry, just sorry for the cough. Just please deal with me this week. I promise it will be better next week. We're gonna fight this COVID. So a call option on Tesla stock that expires on, let's say, February costs $33.55, which is what is Tesla's stock right now? Which is much cheaper than the Tesla stock itself, which is trading at, oh yeah, so $204.99 at the time this was made. Okay. However, as in all of life, but especially in the world of finance, there's no free lunch. So options are cheap not because investment banks are generous towards you, but rather because they're extremely risky assets to hold. So options essentially allow investors to obtain a high amount of leverage, which are often the way investors earn millions of dollars at the expense of other investors losing those millions of dollars. At the same time, options are heavily used in the world of risk management to reduce the risk of certain positions. As we'll see, this leverage and associated risk from discrete payoffs of options, as well as the fact that they have a time to maturity, which is essentially an expiration date to the option. And although there's numerous types of options, the two most common and the two that we'll go over today are the put and call options. So the defining characteristics of put, calls, and puts, which is what I'll be referring to from options when what I'll refer to options from now on, is the time to maturity and their strike price. So essentially, these options entail investors betting on whether or not a stock's value will be above a certain price for call options or below a certain price for put options. So to demonstrate, I'll give you an example of a call option. So a call option gives the buyer the right to purchase a stock at a predetermined price, and it obligates the seller to sell that option at this price, and that's called the strike price. And obviously, a buyer will only choose to exercise this option if the price is above the strike price. If this happens, the buyer will have the option to buy that stock at that strike price, and then immediately turn around and sell it in the market at its current price, earning a profit. And options also have a set maturity date. So the buyer can only exercise the option before or at the date of maturity. If the stock price never surpasses the strike price between now and the option's expiry, then the buyer loses out. So let's give you guys an option or an example. So consider the following scenario. So Oscar's Crunchy Cookie stock, which has the ticker OCC. So I'll just refer to it as OCC. That's my cookie stock, okay? And it's currently trading at $68 a share. And let's say investor Ann sells a call option to investor Bob with the strike price of $72, which expires April 21st, 2023. So in case one, on April 20th, 2023, OCC is trading at $84 a share. And since this is above the strike price, Bob will exercise the option and buy the stock from Ann for $72. So he can immediately sell it on the market for $84 and earn a payoff of $12 a share. And Ann is obligated by the contract to sell this stock. So she can't go back and just say like, no, look at like how much it earned now. So we made a contract 6 months ago that I'm buying it from you at $72. So you need to just sell me at it. If she is in possession of one OCC stock, she can sell it to Bob for $72. If she doesn't have the stock in her portfolio, however, she will have to buy it in the market for $84 and sell it for $72 for a lot of 12 by contract obligation. And case two, on April 20th, 2023, let's say OCC is trading at $68 and Bob would not like to exercise the option to purchase the stock at $72. As you know, he could simply buy it on the market for $68, and therefore he has a payoff of 0. And since Bob doesn't exercise this option, Ann doesn't have to sell the stock, and so she also has a payoff of 0. And in reality, since options are so widely used, most contracts are cash settled. This means in case one, rather than buying and selling the shares, going through that whole ordeal, the contract just ends with Anne giving Bob that $12. So I think this kind of puts it nicely what call option is. So let's move on to put options. So a put option is simply an option where the person who buys the option, or what is otherwise known as a person who has a long position, has the option to sell the stock at a certain price, while the person who sold that option or has a short position is obligated to buy the stock at a certain price. So now consider this new scenario. So today I have a competitor, OCC's competitor, Thomas Chewy Crackers, TCC. Who would prefer crackers over cookies? Well, and TCC is doing slightly better than me, trading at $146 per share. And sells a put option. So it has a short position while Bob is long on the put. And the strike price is 150. The maturity date is September 15th, 2023, 11 months from now. And in case A, on September 14th, 2023, TCC has a price of $155. Bob, who is long on the put, has the option to sell the share of TCC for $146. However, he could sell the same share on the market for $155. So he chooses not to exercise the option. And so both he and Anne have payoffs of 0. And in case B, the day before the expiration date, TCC has a price of $130. And in this case, Bob has something to gain. Therefore, he'll buy one stock of TCC in the market for $130, then exercise his option to sell to Anne for $146. And then so his payoffs are thus $16, while her payoffs are minus 16. So there's always an equilibrium. So there's always something given and always something being taken, a winner and a loser, basically. So now Anne lost $16, and in the call option, Anne's giving Bob $12 because she lost again. So Anne's kind of down bad right now. So what is the benefits of the options? Why even bother? So you might be now asking why Anne would ever short either a call or a put. So Bob's payoffs are either 0 or positive, depending on the case, while Anne's payoffs are 0 or negative. And the details lies in the words that we're using right now. Notice thus far, I've only used the words payoffs to describe outcomes and distinctly not profits. Payoffs are described by the sense that they're the intrinsic value the option has. However, options also have prices. When Anne shorts a call or shorts a put, just as when you short a stock, she gets money. Taking a short position in an option is equivalent of selling the option. Depending on the strike price or other factors, this price, known as the premium, will vary. And thus, while Anne's payoffs are negative or either 0, her profits will be positive if Bob chooses not to exercise the option. On the other hand, if Bob doesn't exercise his options, he'll simply be losing money that he therefore spent on purchasing the option from Anne in the first place, this contractual obligation. And therefore, you'll often see payoff graphs and profit graphs as shown. Let's take a moment to analyze what these graphs are showing. So first, the chart on the left, it shows a call option up until the strike price, then the payoff for the long position is 0. So once the stock price reaches that strike price, the payoffs increase by $1 for every dollar the stock price increases. And the payoffs for the seller are the opposite. So up until the strike price, payoffs for the short position are 0, and for every dollar the stock price increases above the strike price, the seller's payoffs decrease into negative buy ones. I think if you guys watch the Big Short, I think this kind of encapsulates what was happening. So someone bought the what was it called again? Essentially, that contract that he was gonna short the housing market. So yeah. And then and the banks, every time the stock went down, he was gaining money, and every time the stock went down, the banks were losing money. So the payoffs for the sellers are the opposite. Up until the strike price, payoff for the positions are 0. And compare this with the chart on the right. So profit charts are simply the payoffs translated downwards for the long position and upwards for the short position. And the magnitude of this shift corresponds directly with the price of the options, otherwise known as the option premium. And notice that the profit for the long position is negative until the stock price is sufficiently above the strike price. Similarly, for the profit of the short position, is also positive until the stock price is above the strike price for an amount. I'm sorry for the stock price, strike price confusion, but and you now I kind of implore you in your sector teams afterwards to kind of come up with an explanation for this difference on your own. And then, as always, the slides will be posted or sent to you. I'll actually send it to your directors afterwards so you can kind of review this. So advanced options. The only thing we have yet to discuss now is how option premiums is determined. Put simply, it's a lot of complex math and statistics that goes into determining these prices. Well, at the end of the day, it is still supply and demand that determine the equilibrium price of options. There is so much math and technical analysis that goes into option valuation that hedge funds and often other large financial institutions will adjust their demands and supplies of options until the price is one determined by the mathematical formulas. Yeah, so this is what I'm saying, that there is this kind of trend moving towards the quantitative side of finance, and I encourage everyone to kind of do a little more research on this fact, and so an example of this is pricing formula for a specific class and of call and put options is, you may have heard of it, the Black-Scholes-Merton formula, as seen on the screen, otherwise known as the Black-Scholes formula. So the BSM model is derived from complex statistical processes of stock prices and assumptions that regarding of their returns over time. So it's a time series formula, and the specific class of statistics that goes into this formula is stochastic processes, which uses stochastic calculus. And in the future, you may even learn this. And inside, there's also a subset called Ito's calculus, which is derived by this Japanese financial genius. And all of this is under the umbrella of time series analysis. And this type of analysis is very theoretical and mathematical, and courses are often offered only at the 4th-year level and mostly in master's and PhD programs. I know there's an math course, APM Applied Mathematics course. Oh, APM 462. That's essentially like mathematical finance. And that's kind of what you'll be doing with this stuff. And I know people in that class, it's like a PhD. Oh yeah, 466. Yeah, I can't remember that. So yeah, I think you'll be in the same class with like masters and PhDs. But yeah, if you can take it, you should. I heard too many course codes. I actually wandered into an RSM 333 when I wanted to go to Eco 333. So yeah. So what's even happening right now, right? Like, what am I even saying? So there's some intuition that we can gauge which options will have higher or lower premiums. And the main factor that determines the option prices are the strike price relative to the stock price and the volatility of the underlying stock and the time to maturity. So just remember these key details. And if the strike price is close to the stock, the stock price, the option will be more likely to go from a payoff of 0 to a positive payoff. And in option terms, it's more likely to go out from the money where the payoff is 0 to in the money where the payoff is positive. And if the stock is more volatile, it's more likely to be more in the money. In other words, there's a higher chance that the stock will vary in the money. And notice that we don't just care about the stock because it could be very out of money as well, as the payoff of an out of the money option is 0, regardless of how far it is away from the strike price it is. And lastly, if the time maturity is longer, the option will be more expensive. Just like an increase in volatility, longer time to maturity means that there's more time for the option to go further into the money. And when I say into, out of, is just like how close it is to the strike. It's like a limit going to its strike price. Yeah. So yeah, conclusions. So this has been a very brief introduction to the world of options, quantitative finance, CAPM. I'm sorry to dump all of this on you. We didn't even get to like a lot of the corporate finance stuff like Miller-Migliani, MM model. So that's why I wanted to do maybe a part 2 of this. And there's so many different types of options, even within simple calls and puts. For example, American options can be exercised anytime, whereas European ones can be only exercised upon maturity. I lost 15% on my exam because I got them mixed up. Even more diverse options are the family of exotic options, which include compound options, Asian options, shout options, and more. And these are even more mathematically complex and often do not have a closed form solution to calculate the option premium like the BSM model. Instead, they require intense computing power and simulation to come up with a fair equilibrium price. Everyone should learn like a C++ if they want to work in quantitative finance, because that's what they mainly use, not Python. And options are also more than just assets to hold on their own, and different amounts of calls and puts can be put together to design an even more complex payoff graph, which allows investors to bet on factors such as the volatility of the stock as opposed to just the price of the stock. And lastly, as mentioned, options are hedging tools. Options can often be described by their Greeks. The common ones are often known as deltas, gammas, vegas, thetas, which correspond directly with how the value of an option is affected by the change in the stock price, changes in volatility, or changes in time. As such, if you're interested in learning more about options as well as other derivatives, there are it's taught in way more detail in risk management courses. At UFT, these include for the commerce people, RSM 435, the actuarial people, ACT 370, and for the arts and science and economics people, ECO 461. However, now that you have the fundamental knowledge on how options work and the factors that impact their prices, you should be able to kind of explore how options come into play in the real financial markets. And I am sorry to go over time. Let's kind of come to a close here. If we have any questions, I'm gonna stay back. Otherwise, the directors should have everything they need for your sector teams.